Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
What is up, everyone? Happy Friday. Welcome to the Black and White Market Minute on Life Planning 101. Today we have a new face, a new voice, Tanner Carter over here with Aaron and Sam and myself, Kade, as well. How are y'all doing today?
Great day.
Great day. Good day in the markets, a buying opportunity today. So
yes, finally.
Yeah.
Finally.
2 days of breather.
So I think that's an important point. We've needed this, and even if we can come down 10% or so, I would welcome it. And you can think about something like that. It's just a redo, Boy, I wish I would have bought that. So if we can get a little bit of a breather and things slow down, it's not going to be a bad thing, and I really hope it does. Kind of a funny story. That's how I got into NVIDIA. I couldn't stomach paying those prices, but COVID gave me an excellent time to get in, and it's worked out well.
Yeah, it's done something since then.
Yeah,
that's for sure.
Just a bit.
I love the idea of always having a buy list and watch it. Eventually you're going to get your day in the sun, and you're going to get the opportunity to buy, and that's always a fantastic thing. So, good mindset is not to look at a down market as bad. It usually turns out to be a really good thing.
It's a very reframing strategy of seeing that bad market as an opportunity to get in while it's hot.
Amen.
Well, and it doesn't always have to be the whole market to be down to find those buying opportunities, and I think we're going to get into that here in a minute. But
yes.
Just thinking, if you looked at United Healthcare, for instance, it was down, 50 to 60% at one point. There's been a few over the year that have dropped into, I don't know, define reasonable, but at least lower prices in terms of what you're paying for the company, and it just makes it interesting, anyways.
Well, I think you could look at it both ways. You could tell us about quantum. Very, very, very exciting place. It's going to be changing the computing world, and we've been trying to buy a position. And the silly thing will not go down. It's the stupidest thing I've ever seen. Where it was up 100% or so in the last month or two. Yeah. It is through the roof. And, normally when things are moving like that, it's 2 steps forward, 1 step back. So they're like, oh, surely tomorrow it'll retrace and we'll buy in. Nope. Doing it again. Nope. Doing it again. So it's extremely frustrating when price only goes one way, and it's up or down.
Yeah. So. And sometimes the business fundamentals can follow the price, and sometimes they become completely disconnected.
Yeah, I think the way I picture the market is a true pendulum, and the bigger the market is, you think about the fulcrum, how long your pendulum is, and you start swinging that thing, and the very, very bottom is fair. That's fair price. So it spends about a quarter of a second there, and then boom, it's either getting overpriced or underpriced. I guess my point was, if you're following fundamentals, it's just that quick as well.
Yeah.
Hopefully you're buying it on the backswing when things are cheap, but things move in a hurry.
Yeah, and that reminds me of COVID. Buffett had talked about COVID was so fast that he didn't get an opportunity to even really consider what he wanted to buy or not. It was over by the time he was getting his head wrapped around what he wanted to buy.
Yeah. If y'all remember, it wasn't even a full statement if you only got your statements quarterly. I think you were down for 1 month out of the first 3. It dropped that fast and recovered that fast, and it was the largest drop in history over that time period. So it was brutal.
I knew people who really got in right on that bottom, and then when everything kind of went back up, they cashed out real quick with it, especially for the airlines. That was the big one that I remember talking about at college, was the airlines.
Oh yeah. We thought that was silly. Travel got beat up really bad, so airlines was a big theme. Cruise lines as well. Blink of an eye, you better be ready.
Well, and it's all connected. The travel all connected to oil and gas. Oil was negative. What was it? Negative $34, which is just unrealistic and asinine.
I loved, looking back, I loved how many people called wanting to know how to take advantage of it. It was very difficult. It's very, very difficult to do. We would have to play in the futures market. So what are you going to do if you got delivery?
Mm-hmm. Where are you going to store the 10,000 barrels of oil?
Yeah. I think there was a couple, what is it, XLO or something like that. There's an oil ETF, but it didn't price. The financial markets traded were not the same as real-world futures markets, so it's a little bit off there. But it was a cool time, and I really liked that people saw the opportunity instead of just fear.
Mm-hmm. Yeah.
So let's get into this market. This year's been crazy. The whole market is AI. And we are seeing incredible spending across the market, and a lot of things are moving. If we're looking at the market, I like to look at Spider's ETFs on the sectors, and we printed them all out for 1, 3, 5 years. This year, we got just a couple that are around the 20% mark. Technology, of course, communication services. Let's see, what are some other? Utilities and industrials. And then everything else is basically flat. So one part of the market is working, and that's it. And it's been that way for 3 years. It's been that way for 5 years. So when we say the market is way overpriced, that's right. But when we look at the market, we look at it as cap weighted, where you got $4 trillion companies, almost $4 trillion company, $3 trillion companies. So that Mag 7 is making up, not quite half of the S&P, but a lot. Just a few companies, and those are expensive. But there's a huge part of the market that is undervalued and unloved, unrespected. Let's just call it forgotten. There's only one way to invest, and that's AI. But I really can't think of a more exciting time to invest. If you just sit down and think how different your life is going to be 5 years from now, how different your life is going to be 10 years from now, and knowing you can sit in a chair and take advantage of it today. I missed it the first time going around during the .com stuff. I was still playing in school. But this is exciting. Super, super exciting. And it's a whole spectrum of things that are opening up. The big one with AI is we need a lot of data, and we need a lot of computing power. So that takes a whole lot of energy, takes a whole lot of space, takes a whole lot of cooling. So what's moving? What's going on in the energy? If you go out there and look at nuclear, which that's a really, really fast fix, it's already, there's several companies out there that are putting out these small modular reactors. And then these things are small, but they can create enough power for an entire town. And that's what's going to be needed. They're putting in a data center in Abilene, and it's huge, hundreds of billions of dollars. And how are they going to power that thing? How's that going to happen? How are they going to do that without, the residents of Abilene having to pay extra for that electricity? I mean, there's going to be competition.
It's not going to be the windmills?
The green ones?
Yeah. The bird killers?
Yeah. No, not really going to be that. I've heard that they're going to be piping in some natural gas, which would be great. We've probably talked about that. It's been a travesty that we have not used more natural gas to power this country. We've had around $2 natural gas for how long? And it is one of the cleanest energies out there. Everybody should have their own natural gas plant in their backyard, as far as I'm concerned, and we'd have already been fixed. But can't go back and change. Can't go back and change history.
Yeah, we missed that opportunity, so maybe now we'll be powering our towns with these modular nuclear plants.
Amen. But getting back to the weird stuff, so we need power. These servers, they run hot. I haven't been in one, but I know on the Bitcoin mining, it's very, very similar type of server, and they run very, very similarly hot. I've heard of people hooking up their servers where the heat that those generate will heat a pool during the wintertime. Those things run so hot. So naturally, we need cooling. Right? So you go look at companies like Train or these big AC companies. They're going through the roof. Any kind of cooling. I've seen portable cooling, portable power. There's a company, what is that, Tcon or... TGen. Portable electricity. You're worried that your data center might go down? Well, hey, I can set up this generator the size of a bus outside, hook it up to a couple of bottles of propane, and there you go. There's just opportunity everywhere. We already mentioned quantum. What else?
Well, I mean, I've seen the comparison. You're talking about cooling in these data centers. I think it was Jeff Bezos was talking a few weeks ago, and he was talking about eventually we're going to be manufacturing these data centers, and they're going to be out in outer space. And so the lack of atmosphere and the room that you have, it's literally called space. You got plenty of space to build out there. I mean, they're going to be building data centers in space is the theory, and it's going to relieve a lot of the power draw on these local communities. They're going to try to do some kind of a solar panel, which is going to be able to absorb a lot more because the solar doesn't have the night and day factor. I mean, the next 10 years is going to be fun to watch.
Yes. Speaking of that, well, not really. Different episode, but what is that other company? The metals company? One of the things that Trump did today, and I'm not just calling him out, so something happened to do with China in the trade, and I think China used the rare earth metals as part of the negotiation. And they've got us there. They are the market for rare earths, and we need all that stuff for our defense, for our computing. It is necessary. But there's a little bitty company out there that is going and scooping this stuff up off the ocean floor, and they're given the green light to go do it. Very green, not polluting anything, not polluting our rivers or anything else, but you don't have to go very far, and you don't have to kick up very many rocks to find opportunities out there today. And I'm excited.
That company, I just pulled it up. It's called literally the Metals Company, TMC, and it's the pressure of the ocean pushes together all of the rare earth metals in the smallest forms, and over years and years and years they turn into just rocks.
Yeah, little nodules.
Yeah, and they're called nodules. Yeah, and so that's a super interesting read if somebody wants to go look at it.
Yeah, I guess we should talk about compliance here. We're not saying go buy any of these companies. We're not saying that all. Just talking about things we've seen, things we've read about. All of these things take a lot of risk, but the biggest thing is just wow. Just look out there. Look what's going on. Look how much it's changing and how fast it's changing.
And if you don't think it is, people always look back so far, like you had mentioned, the dot-com bubble and whatnot. That was when that was happening. No one thought of it like that, and now here we are, and you're teaching it and whatnot. And so just think what you do today, what that's going to look like in 10 years. Because what if
Yes.
What if that's happening now? What if the AI is the next .com in a sense?
Yeah, and it should be. It absolutely is. Now let's talk about the drawbacks. We're at an all-time high. Things are super, super, super expensive. This is being compared to the dot-com boom for a reason. I mean, we're just as expensive there. And you go back, the NASDAQ dropped 90%. So you had $1 million 1 year, and 3 years later you had 100,000. I mean, that's erasing some wealth.
Well, and the CapEx in that time frame, so they laid how much fiber optics that went unused for 3 to
Yes.
5 years. Now, I mean, it was eventually utilized, but it was a misallocation of resources that was 3 to 5 years too early.
Yes, and same thing. You put .com in your name, and your stock's going to go through the roof. Now, there's definitely differences. The companies that are driving all this are the highest quality, most cash-creating companies on the planet. So it's way, way different from that standpoint. But pricing, the excitement, everybody being a stock guru, I mean, all that stuff is starting to line up to be pretty similar. So what do you do if you're this excited and you know things, our lives are going to be different in the future, and you also know this is a tremendous risky time to be buying. You could be buying at the top. So what do you do?
Rule number 1 is don't lose money. Rule number 2 is don't lose sight of rule number 1.
I didn't know Henry was in here. Gosh, I didn't.
Yeah. But okay, let me throw this out there as well. How long have we been doing this podcast?
Good while.
Have we ever not said we're at an all-time high? Stocks are expensive. I mean, I think we've been preaching how, compared to our historical numbers, how expensive the market's been since about 2010, 2011. We've had tremendous growth. So don't lose money. Go hide in a money market or treasury or something like that. What if this continues to run for another 3 to 5 years? That's the risk. So, and it's a tough call. It's a very, very tough call. And especially when you got a market like right now that it's a house divided, right? So you could just see technology not even move. If the technology stocks did not grow or did not lose for 2 years, you'd give up on them. They'd eventually start going down. But if that could happen, and they doubled their earnings within that time frame, boom, they just got half as expensive.
Without the price moving.
Without the price moving. So let's let some of these other sectors play some catch up, because they're all going to benefit from this stuff too. But to me, being a value-oriented investor, this has been one of the hardest 20 years I think anybody's ever seen. People have given up on value investing. Those are called the old rules, or everybody just knows that you can't. Buying on valuation doesn't work like it did 20 years ago. PEs, price to books, all of those don't matter. Not like they did. We have technology, and we have code that's not. You can't really value it on your balance sheet like you could a factory and that kind of thing.
Yeah.
So the market has changed. The way we look at the market definitely has changed. But I don't think the answer is giving up. In my ideal scenario, we say, okay, I'm an aggressive investor. I want to go get this as much as we can. Say, hey, well, why don't we take 10% or 15% and put that on the sidelines? That we're going to hold this in a money market or a short-term treasury, and if the market does drop, that's our dry powder. But with 85 to 90% of it, we're going to keep going. What happens if it drops 50%? I mean, it's not near as painful, but at least with that cash on the sidelines, that makes a big difference. That makes a big difference. And if you have that excitement that you really think the world's going to be different in the future, to me, that's the way to go.
Well, and when I say don't lose money, I don't mean don't have a negative day, month, week, year, whatever. I'm thinking permanent loss of capital. If you're allocated in a way that you can't sleep at night, and then the market falls, how liable are you to trip up over yourself in order to get out of the market and miss at the wrong time and miss the total recovery? So that's don't lose money means invest appropriately for where you can tolerate
Amen.
yourself, and then you will be encouraged through the rebound after market values get to where they need to be in order to be a good, healthy, broad-based rally market. But if you think that, hey, the market's been going up 3 years in a row, it's just going gangbusters if I don't get in now, and put on more risk, then I'm going to miss out on the whole thing. It's those drastic changes in racing and chasing markets that typically get you over your skis and result in permanent loss of capital. Yeah.
We always preach risk, risk, risk. Make sure your risk is right. And I'm not saying don't take risk. Sam put it perfectly. Don't be over your skis where you're taking a different kind of risk than you can handle. You got to be able to withstand it. You got to be able to sleep at night. We have super conservative investors and super aggressive investors. We can take care of them, all of them, but just make sure you're good.
Right. Don't just copy someone because they're making bukus of returns, because I can bet you one wrong day, and
that doesn't work.
They may sleep soundly with whatever they have. Sam probably does it really great as he puts on his balding cream and whatnot, and he's all risky. But I can't do that. With my full head of hair, we don't want to risk it. So I had to get at least one ball
Talk
joke
about
in.
getting over your skis. You may not make it over to the other office. The air conditioning.
This will be my last episode. It's been a pleasure.
The balding cream is not from the markets, it's from the kids. So.
That's fair. But that's a big piece of it that people don't realize is they want to be risky, and if it's going to cause you stress, that's an important factor, I think, to put into it any day is, and like you said it really well too. Don't just pinpoint a certain time frame in the market. Don't look at it from day to day, because it's going to go up, down, and sideways.
Yes.
You got to zoom out to some point.
And another very powerful thing is your ability to take advantage of down markets. So if you're contributing to a 401k or something like that, you're going to have money that comes in every single month. So you want the market to drop. Say, please give me 50% off. That way I can double my money when it gets back to normal. If you don't have that opportunity and you're living off your funds or something like that, we got to be kind of a little bit more creative to create that opportunity. But it's doable. But I think if you have normal investable funds coming in, whether it's from no matter the source, I think you could probably take a little bit more risk here, knowing that you'll be able to take advantage of it.
Yeah. Well, and let's do a quick study, just real quick. And I'm not saying this is like the 90s, because quality of companies and whatnot are different. But if you chased markets in the 90s, you probably got in at the latter end of that big market rally. You got in 99, 2000, something like that.
Yeah.
And then you had to experience the next 2 years if you had the stomach to hold on to it. So, then how long did it take you to get back even? And then by that time you experienced the great financial crisis. You were barely even when that occurred. So if you start chasing markets and investing for, chasing those returns as the market either, might get over its skis or whatnot, you're going to end up shooting yourself in the foot. So just find a good even keel that you can stay on the course and stay retired.
Yeah, stay retired. And remember, everybody, the market average is 10. The market doesn't average 30% a year or 100% over 2 years. That's silly. Boy, when it happens, we get awfully excited. But you got to know that it can't keep up at that level. And, an easy thing is just think about reversion to the mean. If we're averaging 10 and, hey, we're up 50% over the last 2 years, say, hey, that still can come down 30%. We'd be normal. So it may not happen, may keep running, but I mean, if you can just think about that and keep that in the back of your mind, then if you do get a little bit of a correction or a little bit of a do-over, you're not so shocked and stressed.
And that's the importance of having, like we were talking about before, some dry powder for when it does all that stuff. Take advantage of it and have it there so that way you can reap some of the rewards with that pendulum swing.
Yes. And we're definitely not saying that the market's going to come down right now. It's going to need to eventually. We are out there. We're looking at different credit markets. Usually those are the first to crack. We did have a really big bankruptcy here very, very recently. Owner of Tricolor, which was a lending firm. We're starting to see maybe some stuff happening. But again, this may be so early, causation and that type of thing, If jobs keep coming over and we're creating bigger jobs and we're spending more money, this growth can continue on, and this was just a head shake. So, no reason to be negative. This is more of a time to say, hey, please keep making this about politics. Please give me better prices. If you just come down 10% more, then I'm jumping in. It's an opportunity.
Yeah.
Let's go.
Well, and for every potential crack that might be showing itself, there's a lot of signs out there that none of this is going to be slowing down. So,
yeah.
I mean, if you look at big companies or acquiring small companies, you got all kinds of stuff going on that's just crazy growth oriented.
I think an easy way to look at that is this year, March, April. We saw some of our favorite AI names come down 70%, 50%, and the bottom just fell out of them overnight. We were so terrified we doubled down, and now they've well over doubled, and from beginning to end we're up 70 to triple digits. Wasn't fun, but we wouldn't have been able to do that if we weren't on top of things. We didn't know companies. We didn't have dry powder. If we weren't hoping for that to happen so we could take advantage of that. And that just comes down to a mindset. Please, please, please give me a better deal tomorrow.
Yeah, when you're doing cardio, that's not fun either. But then when you got to run from the wife, I mean, you're glad you did it.
I don't even know what that means.
Well, we've been rambling on for a bit here. We better close it up pretty quick. Does anybody have anything else they want to touch on before we close?
Hey, you might want to leave now before Mr. Hair Cream catches you.
Don't worry. I plan on, I think the sun will burn his bald head and he won't be able to focus on me, so it'll be fine.
I want everyone to know that I have not shaved my head. It's not that bad. So anyways.
Or so he thinks.
We had a list of stuff we were going to cover, but Kade here kind of threw us off course. We'll talk probably the trucking recession next week and some other things. But
I think that'd be great.
For the time being, thank you all for listening. That's going to be another episode of Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.